Due to the low inventory of investment properties on the market, a seller's exchange options are very limited. If a seller wants to defer capital gains, they may need to explore some alternative options.
Absolutely. It's challenging when the available properties don't match the seller's criteria for the down leg of a traditional 1031 exchange. But luckily, there are other options we can explore that will allow a seller to defer gains.
One option worth considering is an UPREIT, or an umbrella partnership real estate investment trust. It may sound complex, but it's actually pretty straightforward.
Before we dive into UPREITs, let's quickly go over the basics of a REIT, Real Estate Investment Trust. A REIT is a company that holds a portfolio of income-producing properties, typically specialized in one asset class, like retail, medical, office, multifamily, industrial, or even data centers. These companies pay out dividends to their shareholders, just like a dividend-paying stock.
Exactly, and the beauty of REITs is that they're accessible to nearly everyone. Just like buying stocks or mutual funds, investors can purchase REIT shares through individual company stock and even exchange-traded funds. This allows people to benefit from commercial real estate income without significant cash, risk, or time investments.
And while REITs can be publicly traded or privately held, they're typically professionally managed to maximize shareholder income and minimize risk. Currently, publicly traded REITs own over $3 trillion in real estate assets.
Now let's talk about how a property owner can leverage a REIT to defer capital gains through an UPREIT. Instead of a traditional 1031 exchange, they can exchange their property for shares or units of the REIT with a value equal to their current property.
That's correct. So, for example, if a seller owns a $5 million commercial income producing property, they can perform a Section 721 exchange by exchanging the property for $5 million worth of dividend-paying units of the REIT that acquired the property. This property for shares exchange is permitted under the Internal Revenue Code, IRC 721, and no taxable event occurs. And here's a critical point. Each REIT specializes in a specific asset type, so identifying the right REIT for the commercial property is crucial in executing an UPREIT.
However, we must highlight that UPREITs and 1031 exchanges are different processes under the IRC. The IRC doesn't allow 1031 exchanges with REITs because the property for shares exchange is not considered like kind.
Good point. Also, just like in a 1031 exchange, there is an intermediary involved in the UPREIT process. In this case, it's the operating partnership of the REIT.
Now let's go over the advantage of UPREITs for sellers. For one, sellers can defer capital gains, which is a significant benefit. Additionally, UPREITs offer a passive investment solution, providing sellers with an opportunity to exit the property management side of things.
Plus, UPREITs are highly liquid investments. Shareholders can easily sell their shares and convert them to cash whenever needed. However, it's essential to be aware that there are downsides. As a shareholder, not a property owner, you may lose certain tax benefits like depreciation, and you won't have any decision-making role as a passive shareholder.
So an UPREIT might be a suitable option for sellers who prefer not to continue owning and managing commercial properties, or those who can't find an acceptable 1031 exchange option in the current tight market.
Exactly. It all comes down to understanding the seller's goals and understanding the most appropriate solution for their specific situation. Quick disclaimer, Sterling Commercial Real Estate Advisors does not provide tax, legal, or accounting advice. You should always consult your own tax, legal, and accounting advisors before engaging in any transaction.